Welcome to the Chrisman Commentary, Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include preparing for MBA Annual in Las Vegas, my interview with Covered Insurance's Jerry Halbrook on how insurance is rapidly becoming central to the borrower experience and the mortgage industry's shift toward embedded insurance, and just what the heck is going on this week with the government still shut down. Today's podcast is brought to you by Flowify, an industry-leading point-of-sale platform. With Flowify's new dynamic AI feature, lenders can modify applications with no coding required and rely on AI to autofill key application fields, allowing borrowers to fill out only a few fields relevant to their needs. The result? Faster completions, fewer drop-offs, and smoother approvals. Discover smarter lending at flowify.com or visit Flowify in person at MBA Annual. There are a handful of important events to attend every year and several state and local events that have merit. Roughly 3,000 people are bound for Las Vegas this weekend to attend the MBA's annual convention. Most will be traveling through airports with carpet. Some don't like carpet in the terminal, but there's a reason it's there. Put simply, the airport's carpet role is to cut back on noise and improve acoustics, making for a more relaxed and comfortable experience for everyone. On top of that, carpets, apparently, or better yet, the feeling they inspire, also make travelers want to spend more money. Interesting. A portion of the discussion at MBA Annual will be about Federal Reserve independence and rates in general. New York Fed President John Williams and San Francisco's Mary Daly have signaled support for more rate cuts to cushion a weakening labor market, saying inflation pressures from tariffs remain limited. Fed Governor Michael Barr, however, urged caution, citing persistent inflation risks and uncertainty amid a government data blackout. The divide sets up a contentious debate ahead of the Fed's October 28th and 29th policy meeting. Yes, amid a data void from the government shutdown, markets have turned their focus to Federal Reserve commentary and inflation expectations. Inflation concerns are growing as households anticipate rising prices, not only from food and gas, but also from tariffs, potentially keeping inflation above the Fed's 2% target. Mortgage rates dipped for the first time in 3 weeks last week, though Treasury auctions showed weak demand, and Fed minutes revealed a more hawkish outlook than expected during the September FOMC meeting. While consumer spending remains resilient, signs of strain are appearing through rising delinquencies and tighter lending, especially among lower-income households. For today's interview, I want to welcome to the show Covered Insurance's Jerry Halbrook to talk about how insurance is rapidly becoming central to the borrower experience and the mortgage industry's shift toward embedded insurance. He was just appointed president and COO of Covered Insurance, the embedded insurtech platform transforming how lenders deliver insurance. But he's formerly held roles as president of Black Knight, co-founder of Nextstar Financial, and chief mortgage innovation officer at PennyMac. Let's start by talking about kind of the insurance space in general. There's recapture wars going on. There's technology wars going on in the mortgage industry. But insurance is also a huge customer experience component. And it's been something that doesn't get as much attention as maybe rates do, but it can scuttle deals almost more so. The cost of insurance, we've seen it rise in a number of states for various reasons. If we could step back for a second, kind of, how do you look at the insurance landscape in the mortgage industry right now?
Yeah, it's a little different on the origination versus the servicing side. So I'll kind of touch on those specifically. But, clearly the rise in interest rates over the last few years, rising house prices have, created affordability issues across the industry. And so that's no surprise. Everybody would hear about it every day on the news, right? I think what has happened in that space and why you're hearing a lot more talk about insurance is because obviously it is required on every mortgage transaction. As you said, lenders on the origination side, we're starting to see lots of fallout of deals that couldn't get over the affordability threshold because of the cost of the insurance or the lack of availability of insurance in certain markets. Obviously, California, where you are, is one of those where insurance is difficult. I live in Florida. It's difficult in Florida. It's difficult in the Texas coast, but we have some guys on our team that live in Ohio, and there's parts of Ohio that are difficult, and North Carolina, wasn't really a problem till after last year's hurricanes, and now that's difficult. So what we're finding with our business model, just to step back a little bit on that, we're an integrated distribution direct to consumer insurance provider through a network of carriers, about 60 full 48 state coverage. So what we're finding is that our partners are our lender partners who source leads to us are looking for an insurance partner that can help them and help their customers find alternative insurance opportunities, sometimes with specialty carriers, sometimes not, that can get them into a insurance product that's affordable, meets all the guidelines with the regulators, um, and also, it can be at a lower cost, so it helps them get over that affordability issue. We're seeing some of that same thing on refis, right? When somebody gets ready to refi, and we're anticipating some of this will happen as rates come down and refis pick up, they're getting higher premiums, or they're finding out that they can't, they don't qualify anymore because their insurance has gone up and things like that. On the servicing side, it's a real issue for the large servicers. I think most of the large servicers we work with have said, that they, the single biggest source of calls and expense into their call centers is escrow questions and escrow shortages, and borrowers who, were paying a certain amount for insurance and they get a renewal and it's significantly higher than it was before, or they get canceled and they're looking at the possibility of, force placed insurance, which is very expensive and not, great coverage for the consumer. So we're getting a lot of traction on the servicing side for the same reason, kind of different use case, but trying to help their customers who are going through either rising rates or affordability issues, or they can't get coverage, or they get canceled and they're like, where do I go? How do I find somebody that will cover my house? And so we can step into those cases and help them find an insurance provider in their market and help them get that coverage and put that in place. And it's helping the lenders save more deals, reduce cost on the servicing side by reducing escrow calls and escrow issues, which, you know, as you know, those are usually consumers who are not particularly happy when they call into the servicer. And so they're customer service issues as well as kind of financial issues for the servicer.
Yes, a lot to unpack there. I kind of want to go in the direction of where the industry is headed with this, because I've said for a while that embedded insurance, or if we could bring underwriting up to the point of search, or if we could get title stuff earlier in the process, then it would greatly benefit the industry from an efficiency standpoint, from a cost standpoint in terms of originating a loan. And I kind of want to get your thoughts, because you've been a leader for years or decades now, on where the industry is headed with some of these parts of the process being able to be rethought, workflows being able to be rethought.
Yeah, I think you're exactly right. And we're seeing kind of an interesting uh, trend in that over the last couple of years. And originally when coverage started, we were sourcing a lot of our leads kind of one lender at a time. We would go out and meet with a lender, we'd get them set up on the program. We would generally integrate to their LOS platform, and we would be part of their workflow. But what we're seeing now over the last 2 years, our biggest embedded partners today are the point of sale providers. So we have moved upstream from the LOS to the point of sale providers. And now we're working on several integrations up in front of that, where we're going to be embedded into the major CRM carriers in the market. So a loan officer who's on a CRM product that we're embedded with can talk to the consumer about insurance, can find out if they have insurance, what their prices are, would they like to shop for a lower cost, and they can do all of that right up front in the process in a lot of cases where Previously, that would have been something that was like, oh, we got a problem 3 days before closing, and a deal would fall out. Now we can solve that right up front with the loan officer, and we can give, insurance options, right at the point of sale through a digital experience for the loan officer and help them with that sales process. So I think you're going to continue to see, and as AI tools get more embedded in the operational side, I think you're going to see the speed of closing a loan accelerate in the market, and having the ability to solve those issues right at the front point of the contact with the borrower is going to become more and more important as the technology continues to expand into the, you know, fast service digital kind of world continues to expand. You're going to see even more interest in that. So most all of our embedded partner projects we're working on right now are with point of sale and CRM providers to move our capability to the front of the process.
I want to talk about you a little bit here because you've had very prominent roles in the industry. Obviously, president and COO of Covered Insurance, also a prominent role. But why was now the right time in your career to go on into the insurance side of things? What intrigued you about this? What intrigued you about Covered?
Yeah, so I've always throughout my career had a, strong interest in solving issues in the industry for that particular lender or tech provider that I was running or leading. So it's always been kind of a passion of mine to innovate and improve the process as we went along. And so in this particular case, I've been doing advisory work with Covered for probably going on 6, 7 years, really all the way back to when they first founded the company. And it intrigued me because of the strategy they have to embed within the lender community, which obviously I know a lot about that, and I know a lot of the people in that market, right? So I can talk effectively to that. And I saw it as a major problem that the industry was facing, and no one was really aggressively looking at how do we change the dynamic for the lender and the customer to solve this problem. And so, it was an intriguing opportunity. I think it's a great company. We have great technology, great people, and we have great partners. And so I think, to me, it was just another step in my evolution of another part of the process that I could try to make a difference in
Hmm.
before I retire and go off into the sunset. So that's really what, and you probably know, I'm sure you do, that I've tried to retire 3 times so far, and I'm not very good at it. So,
Yeah,
uh,
it's an industry that keeps you coming back,
yeah,
certainly.
for sure.
I'm wondering how, I guess we've seen over the last couple years some PR wins for certain segments of the industry. First, it was the non-QM space separating itself from kind of subprime thoughts, at least in the mainstream consciousness of Americans or borrowers out there. Then we've seen recently that HELOCs have kind of had their moment in the sun of it's a much better option than trying to pay off credit card debt or even a personal loan. I could use a HELOC, and some of the stigma has gone away there. When it comes to insurance, what are the battles that you think insurance is fighting from a PR perspective that you see it kind of overcoming in the next couple of years?
Yeah, I think the industry itself has gone through a lot of negative PR around cancellations, certainly in certain areas, and kind of the press around, I paid, in my personal situation, my insurance carrier I had for like 30 years. When I moved to Florida, they wouldn't cover my house because it's too close to the water, right? And so, and even with a customer where you've been with that provider for, 30 years, they have, those risk parameters that they turn on and off based on those risk profiles. And I think the insurance companies have gotten a lot of press, negative press around those issues of not, covering people, pulling out of markets when times get tough, going back in, collecting premiums and then pulling out of the market. So I think there's been a lot of negativity around that. Um, and I think, though, we're starting to see more of the regulatory environment around that, and the restrictions, government restrictions and things like that are starting to be eased. And you're seeing more carriers coming back into those markets because the local and the state governments and insurance agencies that regulate the pricing and control kind of how much you can raise your premiums to fit your risk are easing those restrictions. And so the carriers are coming back in. It's more expensive, but I think the ability to get insurance is easing somewhat from what we've seen over the last, 3 to 4 years.
Certainly, and I'm hearing that as well. Before I let you go, what are you most excited about, or what's kind of top of your agenda? What are you looking forward to?
Well, I think, there's a ton of things to do in the space to continue to improve our partnerships with our lender partners and our distribution channel partners. So I'm excited about, the opportunities there with many of our lender partners. I think on the evolution side of the product and what we provide, I think I'm kind of there with a lot of other people that the AI activities that are going on in the market today create a tremendous opportunity for efficiency and improved service for both the borrower and the lender. And so we have a significant amount of AI related initiatives going into next year to um, focus on how we serve the customers better, how do we improve our delivery capabilities, how do we improve our speed to resolution with our customers. So I think there's a huge opportunity in that space that is very much still in its infancy stage. So from an evolutionary innovation perspective, that's probably what I'm the most excited about going into next year. Is I think we're going to see, and you're already, there were some articles even yesterday about some lenders who have gone full in on AI underwriting and processing, and I think you're just going to see that continue to accelerate. And companies that don't, focus on that over the next like 18 months, I think are going to be somewhat left behind in the market and really have some struggles. So I'm excited about that. It's obviously, new and interesting and different, and I'm not sure anybody really knows exactly how it's going to turn out, but it's certainly creating a lot of opportunity to kind of shake the bag, so to speak, and kind of completely rethink how we do our work and how we serve our customers. And so I think that's a pretty exciting opportunity.
Yeah, I was gonna say I'm excited for you. Let me close with two kind of fun questions here, maybe a little more on the personal side.
Sure.
But when I have leaders on the show, I like to ask, who do you go to for advice? Where do you go to for advice?
Oh, that's a great question. I've been doing this for almost like 45 years, and I have a really good network of like guys I've worked with and women I've worked with over those 40 years. Um, so I don't know that I could say there's like one person other than, my spouse has been in the industry for 25 years or so, and we spend a lot of time off hours debating industry issues, which, may sound boring to a lot of people, but she's probably my biggest sounding board for, how I'm thinking about things. And she has a stronger kind of technology background. So she really kind of helps me think through the technical side of things. So she's probably my number one go-to from that perspective.
That's a good answer. And then the other answer, which is probably, or the other question, which maybe is a little more playful, for these executives out there, for these people that own mortgage companies that are thinking about getting out, maybe they don't want, now we're on the upswing, so it's like maybe I'll ride it, right, roll the dice for one more market cycle. Thoughts on this retiring, coming back that we see so frequently in the mortgage industry, and it's many, many more people than just you, but kind of your
Yeah.
yeah lessons you've learned from stepping out and stepping into it.
Yeah, well, for me, every time I guess I said like I was retiring, it was really more taking a break to kind of think about what do I want to do next, right? What's that next thing that is going to keep me excited and be interesting to try to delve into. So I think I obviously on the origination side, I think we're getting ready, obviously, to go into a much better market. I think for the small and mid-tier fintech companies that have been hanging on through the downside, they're going to have some much better opportunities to kind of monetize their companies over the next few years. So I think it's actually a really good time to be in the market. And up cycles are always more fun than down cycles. And kind of like if you live through the last 3, 4 years of down cycle, and you're feeling good and you're healthy and you're still excited, I think you'll see a lot of those people hang in there and kind of ride this wave over the next few years.
Sage advice, indeed. I certainly wish you the best of luck. I really enjoyed having you on the podcast today, so thank you very much.
Thanks. I appreciate it. And as always, you do a great service to our industry. I've watched you for years and always appreciate your insights. So thank you for your contribution as well.
This week's data calendar would be packed were it not for the government shutdown, with updates on consumer prices, Fed surveys, producer prices, retail sales, business inventories, housing data, import prices, and industrial production and capacity utilization. It was announced today that September CPI will be released, but not until Friday, October 24th. Treasury supply consists of just T-bills, but there is a heavy slate of Fed speakers, including Chair Powell speaking tomorrow. For MBS, Class B and C 48 hours are on Tuesday and Thursday, respectively, while bank earnings get underway tomorrow with Wells Fargo, Goldman Sachs, JP Morgan, and Citigroup scheduled to report. Morgan Stanley and Bank of America are slated for Wednesday. Despite the bond market closure today, Philadelphia Fed President Paulson will deliver remarks. Indeed, traders will be cautious after Wall Street experienced its worst sell-off since the April tariff shock on Friday. Any further dialogue or back and forth between President Trump and China will be closely watched, especially given there's no government economic news to be released. Let's wrap up with a joke and some housekeeping. Columbus discovered the New World, much like a meteorite discovered the dinosaurs. Well, how much oil did Christopher Columbus need to reach America? 3 galleons. And how did Native Americans celebrate Columbus Day? They walk into your house and say, "We live here now." Thanks again to today's podcast sponsor, Flowify. With its new dynamic AI feature, Flowify delivers smarter, faster digital mortgage experiences that lenders can tailor to each loan type. Learn how to reduce friction, boost compliance, and close loans with more confidence at flowify.com or visit Flowify at MBA Annual. And don't miss them at the Tech Showcase at the Fountain Blue on Monday, October 20th at 3:25 in the afternoon.